Now, 2 down days and counting. Is this the start of a pullback for the stock market? One man who is a success story in his own right, who is often associated with bearish observations and warnings aplenty, is FN Arena's Rudi Filapek-Vandyck. So let's see if he's bringing out that cursed bear out of the cave, which he calls his home in Manly. How are you, mate?
I like the intro.
Yeah. I worked on it.
All we now need is a bear somewhere sitting on a chair, but no, I didn't bring him along.
Okay, we'll see whether that bear, well, he'll never get a run on this program again, but you can...
Really? Is that a promise?
That bear will never tour again. He's like some of the famous footballers and cricketers of our time.
Yes, exactly.
Okay, now, Rudy, you've come armed with charts.
I did, actually, yes.
Yeah, and a lot of the things, a lot of people are thinking, well, this is a selling May. A selling May often works.
Could be.
Is it going to work this year?
Could be.
Let's go to charts. Let's go to the first chart. The first one here.
No intro, okay.
Australian, yeah.
I just thought, let's spice up today's program, and I'll bring a few charts, which obviously I think sort of illustrate or characterize the main themes that are currently moving through markets globally, not just Australia.
I say hear to that.
There you go.
Well, there you are on screen. The Australian
one.
Industrials taking out the financials.
Yes.
Ex-financials means no financials.
No financials. So basically, what this...
And it's the PE.
Yes. So there's no resources in there, there's no financials in there.
Okay.
So essentially, this is the underlying industrials base of the Australian share market.
Okay.
In very simple terms, valuations have never been as high, with the exception of the dot-com era in 2007. Now...
Yeah. So what?
Exactly. Well, at the very least, what it means is that this market is not a screaming buy on valuation.
Okay. Yeah.
Right.
Really,
now we go have a discussion whether that means it's fully valued or overvalued or low interest rates.
I had this very same conversation with my colleague Carson Scott on the final count at 6 o'clock, in case people, and it's repeated later in the program.
I was probably sitting in the cab back then.
Okay. And see, when I was growing up, a PE of 20 was like warning bells. Should I buy this company with a PE of 20 when I can put the money in a term deposit at 6%? Because term deposits were 5 or 6%. But nowadays, term deposits are 1.5%. So I say, if a company has a PE of 25, which is effectively a return of about 4%, there's still a long way. Like, you're working in an old world, Rudy. Carson shouldn't. He's a young man. And I made the point. I'm older than him, and I'm thinking new age. You're an old man, or moderately old, and you're thinking old world as well. How can you deal with PEs of, 18? So what? Term deposits are only 1.5%.
Yeah, it's true, but you know that's obviously...
I'm provoking you.
I know what you're saying, because obviously the eternal discussion is this time is different, how different, and when, and etc.
Well, you and I have never seen term deposits this low.
No, and that's what I'm saying. At this point, you can discuss whether that means fully valued, overvalued, bloated, elevated, whatever.
Value. Can we be around fair value?
Well, that's a matter of interpretation. But at the very least, you would have to acknowledge now the market doesn't particularly look cheap.
No.
And to calling it cheap would be that would be quite controversial now.
Yeah, I'd love you to talk to this observation made by Macquarie today. They think the cash rate will go to 1%.
I saw that.
And they're calling the market end of year 5,700.
5,700, yeah.
And I guess as interest rates go down, it does push the stock market up.
Yes.
What do you think?
To a certain extent, that has already happened. Yeah. A couple of stocks I own or I follow are up between 15 and 25%. So I think that's already happening.
Yeah.
What last year we saw, and that's the difference with this year, last year we saw that the prospect and the expectation of more RBA rate cuts immediately pushed up the market to 6,000. That is not happening this year, so I think that there is a little bit more in play this year as well. But it has to be said, if the likes of Macquarie are correct, then well, this market is probably going back to 6,000 at the very least, I think. But I think where a lot of fund managers are struggling now and a little bit cautious in taking this for granted is it's not so much that interest rates and bond yields are further downside to go. It's about sustainability. If it's just a temporary blip, then you shouldn't price it into equities just yet, or never. So you have to be careful in extrapolating too much. The other thing also is which I picked up from analysts who cover yield stocks from the fundamental side,
Yep.
especially the REITs, because they
Which have been good performers.
yes, but there's now more and more angles being published about how low interest rates are actually becoming a negative as well. So it pushes up the valuations, but on the operational side, it's opening up to negatives as well.
Okay.
As a simple example, if you are a utility or a pipeline owner now, you're going to have to pay up for assets, right? And if that is part of your future strategy, that's not looking very promising then.
Good point. Next chart,
Yes.
US dollar.
Well, this is, I believe, the key in the outlook for financial assets.
Okay.
I mean, if we are having a persistently strong US dollar in the times ahead, and this chart would sort of suggest that that might be the case, then I would be more cautious than we're probably acknowledging right now.
Are you saying US dollars are bad for global stock markets or for the
Yes.
US market?
Well, we've seen it in January. I mean, if the US dollar just keeps on rising, we get crisis, essentially. If the US dollar, and this obviously the solution to this question is, what is Janet Yellen going to do? If it's moderate and more moderate than you and I are willing to consider now, then the US dollar might well go sideways over, let's say, the next 2 years. That would be very good for risk assets.
Yeah, okay.
If it keeps on climbing, not so good. If it falls, very good, but of course it can't continue falling.
Yeah, good
and you
point.
see it, for instance, this week as well. What's happening this week? The equities are under pressure, US dollar was up.
No, I agree. And I'm hoping you're more right on the sideways story.
Yes.
I suspect it's going to go higher. All right, let's go to the resources chart you've
Yes.
got. And with selling May in brackets.
I actually thought that was a very interesting one, and that's why I also have
Did
used it a
you
couple
do
of
this in
times.
the back of an envelope?
No, I didn't do that. This is an analyst at Morgan Stanley who thought he brings out his creative genius.
Yeah.
But anyway, what this person has done is he actually has gone through history to a lot of data,
Yeah.
and he has made a point with a lot of arguments there that sell in May actually works for resources stocks, for commodities. And there's a lot of fundamental reasons which we don't have to go through now.
Yeah.
But the pattern, year in, year out, usually is that we're all getting excited in the run-up to May,
Yeah.
and then it sort of like peters off a little bit towards flatline,
Yeah.
and that's when you then shouldn't be there.
Yeah.
And later in the year, in October, that's when you should go back.
But what is that chart showing? Is that
Well, it's sort of-
it's not commodity prices.
No, it sort of shows the excitement or not from investors and where you should go. And I think the demarcation line, the ones you had that's when you should
Okay.
come back in. And that's basically
Give me that person's name. I'll get him to come on and explain it better than
Oh,
you.
yeah,
But you've
of
done
course,
it.
yeah. 'Cause I'm doing a second derivative.
Yeah, okay,
But what
okay.
he's suggesting with this one is that you will have bottoming prices in September and October, what you see,
yeah.
and then is when you go contrarian again.
Certainly, I know Michael Knox
Yes.
called it absolutely right in November of last year and January when he said oil prices go up around late February.
And I'm assuming, I know Michael Knox is someone who does pay a lot of attention to this. I'm assuming
Yeah.
he's using something similar.
Okay, great stuff. All right, if I might get Knox to talk
Yes.
about on Monday. All right, now finally you've got this one, a yield strategy.
Yes.
Okay, let's see this chart quickly.
This is by the likes from CLSA, who actually tried to devise a different strategy because they say there are cycles for yield stocks as well.
Okay.
And so that means that not all yield stocks always perform equally.
Yeah.
Now, in this chart, they've actually made a division between developed markets and developing or emerging markets.
Yeah.
In emerging markets, you're basically you're simply buying yield stocks because they offer you yield, because in emerging markets at this point in time, and you could make an argument right now for Australia as well, that bond yields are still falling.
Yeah.
So all you do is you buy the REITs, for example, because they benefit from falling bond yields.
Yeah.
In developing markets like the US and Europe, you buy a different type of yield stock. That's where you buy the yield plus growth. And I actually have been advocating yield plus growth for Australia as well. Temporarily, those stocks may not outperform, but I will still maintain that through the cycle, yield plus growth will give you the best returns over time.
They're my two favourite words in the world: yield
And growth. But you have to combine them in the same company.
Oh yeah, and that's a really important strategy. We're out of time. What's your feeling, Rudi? Do you think we will see a pullback from here?
Yeah.
but probably not as deep as we saw around January.
Well, it depends. It depends on how intent the Federal Reserve now is. I actually believe they're a little bit beating their chest a little bit too much about June. I don't think that's, well, I can be wrong, but I think that's the key.
Yeah.
And the other key is I think we have support from RBA now. So I would expect that the trading range is now a little bit higher on the downside.
Lovely to talk to you as always, Rudi Filapek-Vandyck from FN Arena. Coming up after the break, the polls are giving it to Labor right now, but who does Malcolm McKerris give it to for the July 2 poll? That coming up after the break.